I think you can never be thorough enough when you do this upfront due diligence. The more hours you spend, the more time you spend, and the more details you get, the less of a risk it is. So I could say spend 100 hours if you have to, right? It's worth it.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms.
All right, welcome everyone to another episode of Spur Equity's Spur Your Wealth podcast. We are your hosts today, Budham Singh and Rav Singh from Spur Equity. And so on our Spur Your Wealth podcast, we aim to bring successful investors, experts, and thought leaders to the podcast to share their story and secret in investing so we can all stand to benefit from their experience. And on today's episode, we are so fortunate to have our dear friend Sandhya with us today. Sandhya, we've known Sandhya for a few years now, and we've been following her. We've been trying to emulate what she's been doing and following in her footsteps. She is an experienced general partner in really all aspects of multifamily, from broker relationships to underwriting, raising capital, to closing syndication deals without delays. She's also, one of her huge strengths is that she's a hands-on operator with a strong focus on asset management, after the honeymoon of acquiring the property is over, to add that value to different customers in apartment investing who are limited partners as well as residents. So Sandhya has invested in over 4,000 doors now with 140 million in assets under management. So really, really impressive resume, which doesn't surprise anyone that we've been trying to follow in her footsteps. And really find an opportunity for us to actually partner together. So we've been looking at that personally. Rav and I have been looking at that to partner with somebody like Sandhya because of her strong skills. So welcome, Sandhya. Really, really happy that you could spare some time and spend some time with us on the Spur Your Wealth podcast.
Thank you so much, and congratulations on launching a podcast. I've been watching your impressive journey, and it would be my dream to partner with you guys one day when I can find the right asset that meets your requirements. But yes, my journey years ago started with, landing like most immigrants here, 2 suitcases in hand, a strong math background, and then getting into engineering. And after that, I started my corporate career with Texas Instruments, and that's where I learned a lot about the technical side and project management, but also moved on to the business side with my MBA and started trading stocks. And I was successful in trading stocks for a while, and I was looking for a place to save on taxes. And I came to real estate, and I analyzed real estate, but found that, single family rentals just didn't have the margins for signing a recourse loan and then managing all these 4 T's, the tenants, toilets, trash, and termite side of things. It just didn't seem to make sense. I could easily make a few $100s on the stock market without having to do any of this. And so when a friend told me about large multifamilies, when I got interested, and that's what I do now, as you described, is I do all aspects of multifamily syndications, and I'm primarily based in the Dallas area. This is where I landed over 33 years ago, and I've stayed here ever since. So my little, competitive unfair advantage, as I call it, is my ability to look at a deal just by its address and say yes or no. It takes me less than 2 minutes to even decide if a deal is worth pursuing. I don't need to drive by it. I don't need to do any of the analysis to decide. So there's very few deals that I actually bother to sit down and underwrite for that reason, because of my market knowledge.
And there's beauty in that, right? Because as we say, clarity is power. You're crystal clear in regards to what you want, what your box looks like, and especially from a location standpoint. So I think that's well said.
So Sandhya, can I ask you a question? So, a lot of us, including Rav and I, we actually, everybody knows that they should be investing in real estate, right? Like it's not some far off wild idea. Like everybody knows that, they should be investing in real estate. They just don't know, one, how to get started. And folks like Rav and I, who also didn't know how to get started, we we just jumped in. We started like single family, like you said, like we did the single family thing. We did, we were looking at duplexes, we were looking at single family and seeing what we can churn out of it. And, we found out through experience exactly what you're saying. Like we can't, there's not enough squeeze, there's not enough margin for all of the hours that we're spending on those investments, right? And yes, at the end of the day, we did make money, but if we factor in the time aspect of it, like it just didn't make sense. So for you, I mean, talk to me. Like I actually don't know. Like, did you actually do the single family thing?
No.
And you never did. So you did the analysis and said, nope, that's not for me. Not enough squeeze for the juice, or not enough juice for the squeeze, and then moved on to something else.
Yeah, the only single family I've ever had are the 2 homes I've lived in, and that's it. That's the only single family loans I've ever signed and looked at. But I had a lot of friends who owned rental properties in the area, and every time I was concerned about, getting the right tenant in, fixing up things, they would call me on Thanksgiving Day with a leaky toilet. Those were my nightmares. So when I heard about it from friends, I was like, that's not something I ever want to do. I don't want to sign a loan, tie myself up with, a couple of $100K in the loan, etc., just to have a single family and ultimately to have those small margins. So you're really waiting for the property value to appreciate to make the big bucks in single family. What if it doesn't happen in your market, right? So I just didn't think it was worth the hassles. So I never did it. So if you ask me about fix and flips or single family, I wouldn't know what to tell you because I don't know. I don't know what it's like.
Yeah, and unfortunately, Rav and I do, because we went through that. Yeah. Fortunately or unfortunately, like, we tried our hand in the fix and flips. We tried our hand in the long-term rentals, the short-term rentals, and like all of them are a very, very different experience. Our limiting belief was that, this is all I can reach, right? That I can never, buy a big apartment complex or anything. This is all I can reach. And so at the time that was true to us, but we knew we had to start in real estate. And a lot of our friends are in the same boat, right? They're friends and family, and they're in the same boat that I can, I have like $50,000 and I can buy a small house and like try the whole, real estate game. But you don't know what you don't know, right? And so what we're trying to do with this podcast and other education is that just show all of the different avenues that are available, both from an active standpoint and a passive standpoint and somewhere in between. And that's the beauty about real estate, is that there's so many different ways to actually invest and make money. It depends on what your skill set is, what your strong suit is, how much time you have to devote to it, how active you want to be. And so as much of that clarity that we can provide hit the same hurdles or the challenges that we had, going through that. So again, I appreciate you being on the podcast to share your experience. So you mentioned, your underwriting. So I think just to put some clarity, you live in the Dallas area, and 100% of your active pursuits are in the Dallas area. They're within driving distance. So like you said, your market super, super well. You've lived there for most of your life. You know that market. And so from an underwriting perspective, which submarkets you want to be in and whether they're going to work economically or not. So you don't even there's no emotional component in your underwriting. You're like, nope, I don't want to be there. I want to be in this area, whatever, right? So talk to me about, so a lot of investors don't understand the amount of work that it goes. So let's say after the fact of, you're saying, okay, I spend 2 minutes based on an address, but let's say it's within your buy box. Now you're doing the due diligence and the underwriting and all of the work to actually figure out whether this is the right fit for you and your investors. Talk to me about that process, like how involved, because you're very hands-on, from an underwriting perspective. So I want to give our investors a little bit of a glimpse into the work behind the work. So can you talk a little bit about that whole underwriting and due diligence process?
Yeah, I think you can never be thorough enough when you do this upfront due diligence. The more hours you spend, the more time you spend, and the more details you get, the less of a risk it is. So I could say spend 100 hours if you have to, right? It's worth it. So one thing I always do is I drive by the property by day or by night, assuming this is in the location I want, right? So a popular suburb like Irving, I've got a couple of properties. Carrollton, I've got a property. So these are all suburbs I want and I like. So the minute the broker sends me something, I am digging in very deeply because it fits my box. I also know my price per door based on the vintage of the property, just because I've analyzed probably hundreds of properties over the last 4 years, and I know friends who own properties in that area. So if I don't already own a property, I probably know a friend who owns that property. So most of my data in my underwriting is from actual data that I can get from them. So what are the rents you're getting for a 1-bedroom versus a 2-bedroom? What is the competitive advantage of this subject property with respect to everything else around it? A drive-by will tell me very quickly. So I personally visit not just the subject property, but also the competitive properties near it. So when a broker is doing a tour, I plan ahead of time to have toured the competition, so that that golden hour or 30 minutes I get with the broker are very specific questions. And the other advantage you have when you tour a property is the people working there, like the maintenance guy, the lead property manager, usually walk with you. You can ask them all kinds of cool questions. If you've done your homework on the competitive properties already, like some basic questions you should be asking is, what is your competitive advantage? And if I gave you 100K, what would you spend it on? If I gave you 50K, what would you spend it on? You want to look at the Yelp reviews ahead of time that are recent. And you want to see what people are complaining about this property or what people are saying great things about this property, as well as the 5 competitive properties nearby. What's a competitive property? Similar vintage, within a 1-mile radius, with a very similar set of amenities. And you also want to look geographically, if it's on the same side of the highway, seems by the same school, etc., because those little things make a difference, even though it's only 1 mile. In your underwriting, every input must come from a neutral third party. It cannot be, oh, I think I can get $200 by putting stainless steel appliances and a granite countertop. Well, who verified that? Where is your property, subject property, with respect to the other competitive properties in terms of, is it at the top of the market in rents for that unit type? What unit types are really preferred there? Are you looking at families? It's a school nearby versus it's more of 1-bedrooms and it's the single guy with a job nearby, right? So that demographic makes a very big difference in terms of that competitive analysis. When I say every input must come from a neutral third party, every loan term must come from a lender's term sheet. And if it's somebody like a Freddie Mac, you can lock in the rates weeks ahead of time. So when you go to do a webinar presentation, you know exactly what your interest rate is. It doesn't matter what Powell does. That's huge, right? Your expenses, your rents, and your other income must come from the third-party property management company, or if you're vertically integrated and you have data from similar properties within that 1-mile radius. That is very important. So if the PM has never operated in that zone, that area, then their data is not as valid. So you can't just trust like a CoStar kind of data. Something else that we look at in terms of location that I take for granted because I know this market so well that you should be looking for is diversity of jobs, job growth and population growth, but different industries. That's very important. You're not just dependent on one military base. You want to make sure the median household income is high enough to support your highest rent. So if your highest rent is like $1,300 plus utilities, plus parking, etc., you're close to $1,500. Times 12, you're at 18,000. Times 3 is 54K. You want the median household income there to be well above that 54K mark. Otherwise, you'll result in delinquencies. Your tenants are not going to be able to pay that. So all the nice, fancy rent bumps you assume may not come true. Also, what is a realistic rent bump based on your positioning of that property? You must get, for Texas, the taxes estimated by county by a tax protest company in that area. And same thing for insurance. Get an insurance company to give you a quote who's already insuring properties in that area. Another reason the drive-by is so crucial is because Dallas, for example, is not in a coastal area. It's not like a Houston with flooding kind of issues. But your property could be by a creek, it could be by a lake. You might think it's only 1 or 2 buildings in a floodplain, when in fact it could be 15 buildings, in a floodplain. And that could completely dramatically change your insurance costs. So every input in your analyzer must come from a neutral third party. That's the only question you have to ask as an investor or as a co-general partner who's raising money for somebody else. Who's the underwriter and did they do that? That's the most important thing to ask.
That's really good. A quick question before I know, Parmi probably had a question. That's very important, right? What you're saying when you're buying a property. So that's one side of the equation. The other side of the equation is, let's say if I'm the investor and I'm a first-time investor, I've heard Sandhya speak at functions and my friends have invested with you, but I'm new coming to the business, right? I'm new coming to investing, and I like stock market. You've done stock market. I understand that, right? So from an investor standpoint, what are some of the top things that I, as an investor, would need to underwrite in terms of a sponsor itself like you? What should I be looking in you to make sure that I'm giving you my money and my money is safe?
So the most important one is just like asking for references for a contractor. If you're going to do a 50K kitchen remodel, what are the questions you would ask? You would want to ask your neighbor or friend who referred you to that contractor, and you have your list of criteria, which is, did they do the work on time? Did they stay within budget? Did they clean up after themselves, etc. So similarly, before you talk to anybody about an investment, what is your criteria? What is your risk tolerance? What kind of cash flow do you need? Is this to pay for your kids going to college in 3 years? Will the investment complete a full cycle by then? So have all of your criteria completely written up before you talk to this person, before you have that Zoom call with this person. Another thing is who referred you to them. If you just spoke to somebody, you just saw them on social media, ask for references. Who will guarantee? If I say, like, my first deal, I tripled investors' money in 27 months, and I could brag all day about it, right? But why should you take my word for it?
Yeah.
You should go say, show me an investor who actually invested in that deal, who will vouch for those kind of numbers. So you ask for references from a prior customer of whatever product or service you want to be using, right? The same concept again. Another question you should be asking is the one I just asked earlier is, what is the source of all these numbers that you put into this magic spreadsheet to come up with these fancy looking returns? Oh my gosh, I'd rather invest with you if you can triple my money than this guy who can double my money. Well, what are the assumptions in that underwriting? Who validated them? One very important assumption, and I'm getting a little technical here, is what we call the exit cap rate. That means, what am I assuming interest rates and cap rates to be in the market, let's say 5 years from today when I'm going to sell this property compared to what it is today?
Yep.
That's kind of like a crystal ball, right? So what is conservative? This is what you have to remember. The exit cap rate, meaning what I'm assuming my interest and cap rates to be later, you want that to be higher than what it is today, because then it is conservative. Because if interest rates and cap rates are higher, your property value actually is going to be lower because it's harder to buy a more expensive property because your leverage just went down. So all you have to remember is, what is your version of conservative underwriting? Exit cap must be higher than the entry cap. All inputs must come from a neutral third party. You must have a reference that's not the sponsor, because the sponsor is like the marketing person. They're going to say only great things about themselves. Who is verifying those results? What is their track record of full cycles? Meaning they bought it, they did the value add, they sold it, they returned money to investors. What is their track record of full cycles in that market? Those would be the most important questions I would ask.
So, and that's fantastic. So there's a lot that we learned, from that. So from both of those questions, just from underwriting and due diligence from a sponsor perspective, and then the due diligence that an investor can do on a sponsor and vetting a sponsor, the key thing that I got from that is be prepared, right? So like, I love in your answer there is that before you even have these meetings, right, before you even go to the property, before you even talk to a broker, do your homework. Do your homework. Like, find out everything that you can about that subject property or that subject sponsor before you have the conversations, because there's so much data that you can actually collect on your own and figure out whether it's worth having that next conversation, first of all. And then secondly, you're even more prepared to actually uncover everything that you want to uncover about that sponsor or about that property when you have those meetings. So you're very, very, very deliberate and targeted about what you want to learn on that property. So don't waste that, 30 minutes time just roaming around and saying, oh, there's a unit and there's a unit, and there's a playground, right? So you really want to dig in deep and get all of the other, kind of unknowns figured out so you can plug them into your model. The second thing I heard, which I think is super valuable, because San Antonio, for example, do this where, a seller's pro forma or a broker's pro forma, they look at it and they take it at face value. I was like, you can't do that. You cannot do that.
Way.
And so, because again, their motivation is different. They're going to be like, hey, if everything is rosy, this is what the property can do. Well, everything's not rosy. And so what's reality? And so you got to bake that back down into actual reality. And so, you can't take the seller pro forma. You can't take those assumptions. You can't take the broker's pro forma. You got to rebuild everything yourself based on a T12, a T3, and just look at competitive analysis around that property. to really see like, all right, what's our worst case, middle of the road, and best case scenarios, and kind of work from there.
Yeah.
So, really, really key points there, Sandhya. So, I think there's a lot of value in again that experience. So it all boils down to kind of educating yourself and making sure you surround yourself with people that know these things, so they can kind of input your thinking.
Yeah,
right?
your risk tolerance is the most important thing of all of it, right? Are you going to invest in small cap stocks? Are you going to invest only in Amazon? It's the same thing, same principle. You take it to these investments and say, what is the worst case scenario and what is a realistic scenario? And that's where we say multifamily is a team sport. So you got to know who's your insurance provider, tax assessor, the physical due diligence person to really assess the building and see what repairs might be needed, even if it's relatively new. There's still things that can happen in storms, etc. You always want to be flush with cash, and you want to know who the legal team is. You want to make sure it's a lawyer that's syndication lawyer, well established, that other people talk about, etc. And you want to thoroughly review those legal documents when you receive them. What are the chances when something goes wrong? What do I have to do as an investor as well? What are my obligations? What if I refuse to answer a capital call of inputting more money into the deal, etc.? What happens then? So those are all important questions to know and have ahead of time, because sometimes sponsors are in a rush. They want you to fill out the paperwork quickly and wire the money, and it's a rush.
Yeah.
But have you had the time? You could ask when you're looking at a sponsor, can you share me the PPM from the past? So private placement memorandum from a past deal, so I can take my time and read it, knowing that the next one is going to be very similar. And that way I'm familiar. But again, another question to ask is, when was the last time you read the prospectus of a mutual fund before you signed over and said, Fidelity, take all my money and I don't care what happens with this target, 2030 fund or whatever.
Right.
So you can't be stuck in analysis paralysis. You have to give yourself a deadline by when you get all your questions answered, and then you have to decide, go, no go. Do I want all my money in stocks, or do I want some of it diversified with real estate, with actual buildings, not a REIT?
I agree. Wow, that's amazing. So we love learning, right? And I think that probably goes beyond saying for everybody, even on people who are listening. So thank you for having introduced this to us and our investors. Now let's talk about you. I mean, where you are today, right? I mean, you're very successful. We already established that. You're teaching people, you're investing. What is Sandhya doing in 2023? I mean, market is probably a little different than what it was in 22 and 21, right? And so tell us about you, tell us about your work, tell us about what you're seeing, what you're not seeing, what you're bullish about. Kind of give us your perspective on 2023.
I'm very much heavily into operations. I always have. When I raise capital for someone, I want to know what's happening in the deal. So being in Dallas with all my deals, I'm usually the main lead asset manager and boots on the ground. And so the biggest piece of asset management is to have that high level helicopter view, like I used to be as a project manager. But then we call this thing called a critical path, which is like at the street level. You suddenly have to fly in and swoop in at the street level if there's a pothole or something else that's slowing down your project. So one of the potholes we've encountered in this year is with the rising interest rates on a floating rate bridge loan. So you've had to watch those pennies even more closely. So some of the simple operational strategies we do is, don't spend extra money to get to the pro forma rent unless you really have to. If you're within $25 or $50, see if you kick the can down the road. Maybe have the renter, especially now we're in the fall season, so you're looking at the holidays now for renewals. So kick the can down the road, do a shorter term lease so that all the leases come off in the peak season. And instead of spending $15K per door to do an interior to get a $200 rent bump, maybe you just do $2 or $3K and you only get maybe $50 less than that pro forma, and that's okay, because even for the next 6-7 months, that's barely a few $100s. So why spend thousands? So it depends on what your deal is going through and what phase it's in. You decide on what strategy makes the most sense. Of course, you're partnering with your on-site to give you that feedback. Another thing we love to do is community activity. So I always have something going on. We have National Night Out coming up in October. We'll be doing, for Thanksgiving, we'll be doing turkeys or pies. We'll be doing Christmas with Santa coming on board and taking pictures, etc. But as far as the
I love that.
market goes, the deal flow was much less in the first half of 2023, but it's picking up now as more and more deals are getting kind of squeezed, if you will, with their floating rate bridge loans and expiring rate caps. So we're seeing a lot more deal flow. But if the right deal comes along at the right location and it prices well with a conservative underwriting, then I do make offers. The biggest constraint right now is you are limited by the debt service coverage. So what is the current net operating income of the deal, and how much is a lender willing to loan to you? Because now your cost of capital has gone up. So if you are buying a $20 million deal, you may have to raise at least 10 million of that money. And when an assumption looks very, very favorable because it might be at a much lower interest rate, but the problem is, again, your leverage is even lower in that case, and you have to raise even more money. So that's the trade-off. Right. Is a lot more investors are reluctant because treasuries are giving them 5-6% kind of money from a lot of treasury and banks. So they're reluctant to part with their money as easily as they were a year ago. So that's some of what I'm seeing as far as the market goes. But with 5 deals that I'm asset managing and launching my mastermind recently, it's been, pretty hectic.
Mm-hmm. Yeah. So let's talk about that a little bit, because your strength, as I mentioned in your intro, and one of the reasons that I admire you tremendously is you're very hands-on with asset management, right? And so, people don't understand, there's a lot of work, like you already mentioned, around due diligence and getting us through the purchase phase of it. But really, that's when the work starts. And so, we have this hurrah, we close and we close on the property, but that's when the real work actually starts in implementing the business plan. That's where the rubber hits the road. And so folks like you, the reason I admire you is you take that to heart and you're like, this is it. This is where we make our money. This is where we make the impact. And people don't really have visibility into the things that you do on a day-to-day as an asset manager. So, you kind of, you scratch the surface a little bit, right? In terms of the potholes or the things that are stopping you from meeting your business plan. But, talk to us a little bit about what you do on a daily basis for the 5 assets that you manage. And then also when everything's great, you're kind of, I don't want to say autopilot, but there are things that don't go the way that you expected them to go, and you need to make quick decisions. Talk to us a little bit about the work of asset management, because again, investors don't have that visibility into the things that we do.
So a really good day would be a deal that's already stabilized, that's 2 years old. We only have calls every other week. The numbers look great. We get the weekly reports and we see there's not really any major problem. Maybe delinquency is going up a little bit and we make sure they're addressing it. That's the nice scenario. Now I'll give you another extreme scenario where in one case in a property, Atmos Energy changed the gas lines at the street level. And so what that ended up happening is our pressure testing failed in all the buildings of our property, subject property, which means gas is turned off. Now that particular property has gas, heating for the water, hot water, as well as gas cooktop. And so we get a call, and of course, just like the movies, it's a rainy, stormy Friday afternoon when the city inspector calls and says, oh, by the way, if you don't get this turned back by midnight, I'm going to pull your certificate of occupancy and you have to put everybody up in hotels. That's going to be a little expensive when you have to do that for 116 doors. And my property manager says, I can stay a little bit late, but I can't do anything else. My credit card is not going to be, able to pay for things. So I drove to this property to a pizza place nearby because they said $2,000 worth of pizza. You can't just, we can't take it over the phone. Went in person, paid for that. We took pizza to all the residents to keep them happy. We have plumbers working around the clock all weekend. Luckily, by Friday night, they were able to turn the hot water on, which is a requirement for you to, have an occupied, apartment complex. And then by Monday, we were able to get most of it turned on. And so we gave them food like this and pizzas. We gave them refrigerated products, gift cards, etc. So that's how we were able to keep the residents happy. There were still a lot of complaints, but we were able to get through it. But that's an example of, when somebody says asset management is easy, that's something like Atmos Energy changing gas lines that hadn't happened in over 20 years. So who would have guessed that's going to happen that particular week? And it was not just our apartment. People think, oh, it must be a really old apartment. Well, the other apartments, the single family homes built within the last 10 years around it, they all failed the pressure test too, and they all had to get work done with plumbers to do that. So it's not all, a cakewalk, but when something like that happens, you drop everything and you take care of that emergency. Same way in Feb 2021, we had a deep freeze for 8 days in a row in Dallas, and we had burst pipes, etc., to deal with. So that's another example. But a typical week consists of asset management weekly calls where we have a set agenda. We always review the same KPIs, and we have that sent to us ahead of the call. So we already know what things to focus on. If things are going well, we don't need to go over it. So some calls are as little as 10 minutes. Some others go a full hour long. Some involve personal visits. So I have 2 afternoons and 2 full days, completely flexible. I try to crunch all my meetings to a couple of days so that I'm free to go travel to these places. But they're all within a 30-minute drive. So on one single day, I could visit all my 5 properties if the whole day was open. And so that's kind of what I do is I visit my properties frequently, especially when we have any change of management, anytime we do upgrades or we get a new vendor, anytime there's a lender inspection or a city inspection. Those are your 2 bosses. Don't ever forget who your bosses are. Lender pays for at least 70% of your property's price. So whenever they show up, you show up. Whenever the city comes and gets involved, it's affecting the safety or health of your residents. You want to be there. So we literally carry these walk around with our maintenance guys carrying all these electrical stuff to fix something by the time they finish their walkthrough. So they know we are focused, the owner is present, this is important to them.
Very well said.
No, that's really important. Go ahead.
I was going to say that very well said because, you really have to be boots on ground, right? You have to take care of issues at hand. And anybody new coming in may not have that visibility, may not have that experience. So it's, in my opinion, it's very important to start maybe passively, as we were discussing earlier, learn and see what other folks are doing, get their knowledge, and see how the deal makes sense. And then eventually you can lead to more of a lead position at that point.
Yep.
What's your recommendation in regards to that? If I'm an investor and let's say I even have lots of family and friends and folks where I can raise capital from, should I be taking that plunge right away and leading a 100-unit apartment complex? Or should I wait and invest with somebody like you and others to learn and, precisely what you just examples that you gave and understand what could happen? How do you deal with it? Give us your perspective.
I don't recommend going alone. Multifamily is a team sport. It's not like buying a single family home where it's just your money that's involved. Whenever it involves other people's money, you must take the least amount of risk, or actually the very, very lowest risk you possibly can. It's just like saying, I want to be a pilot and fly a plane without ever being a passenger. I don't recommend it.
Yeah.
Be a passenger in a plane, know what it's like to navigate turbulence, because if the ride is smooth, everything may look easy. But what's it like when there's turbulence? Can you handle it? And who is with you? Or it's like your first brain surgery. If you're just a recent medical graduate, and you have got the, scalpel in your hands, you definitely want that experienced surgeon there because it involves other people's money and in this case, other people's lives. That's why I don't recommend going alone whenever it is. As a joint venture or just you and your brother, your partner, somebody like that, yes, you could probably do it. But I highly recommend working with a team that has the experience and knowledge in that market because you don't know what you don't know.
That's definitely great advice. And, Sandhya, you have such a wealth of experience in all of these different areas, and I we can sit here and talk to you and with you for hours on end, and I think we definitely want to have you back on the show so we can dive into some of the other topics that we want to share with our listeners. But as we kind of wrap up this episode, I want to ask you for any sort of final thoughts or anything else that you want to share with our listeners, anything that's like a valuable lesson or a story from something that you went through that would resonate well with some of our listeners, or to what Rav alluded to, maybe what gets you excited about 2024 or and beyond, right after we kind of weather the current storm that we're in. So any final thoughts and anything that you want to share with our listeners in that regard?
There's always opportunity in every market. Even when the stock market is down, that's the time you go buy. When the stock market is high, you go sell. It's a similar thing with real estate. You should know the price and value of your product really well. It's just like if you're shopping for a specific product, you know what it's worth. The same thing with real estate, just like with multifamily. I have my little box. I know what pricing works based on the debt structure. So if there's a deal that works, I'm going to go after it like crazy, all guns blazing, if you will, and make an offer within 1 or 2 business days before everybody else swoops in on it. So because of the broker relationships I have here, I'm super excited that I could get a little bit of an early look at some deals before it comes out to the rest of the market. And same with friends in the business. So that's what I'm really excited about. But remember not to take risks when it involves other people's money. And if you think you can do it by yourself, make sure you understand the risks involved. Go with a team that is experienced to learn the first time. It's just like an internship. Go through the internship before you start going on your own and doing things that affect other people's lives. Take it seriously. It's a big fiduciary responsibility. The people who don't have boots on the ground, local knowledge, are the ones who've had foreclosures happen this year. So there's always some bad apples out there in any industry. Don't let it scare you. Take the lessons from it. Go with experience in your first couple of times and have consultants available even when you go on your own, and set a deadline. If you don't give yourself a timeline to be ready, you'll just be drifting forever. A year from today, 2 years from today, you'll wish you had started sooner. And so take this time when the market is a little slow to get educated and make a decision. By the first of the year, you should be ready to say yes or no to real estate.
That's great advice. That's fantastic. That's great. So Sandhya, I want to really thank you for sharing your time and your experience and your knowledge with us. I always enjoy our chats. I always enjoy, meeting up with you, and I'm so glad that we got to share this with our listeners as well. So for those that have resonated with what you're saying and they want to learn more, how does somebody, how do some of our listeners get in touch with you? How do they reach out to you? How can they get connected with you, Sandhya?
So engineered-capital.com. Engineered Capital is the name of my company, engineered-capital.com, and finding me on LinkedIn. That's the easiest way. I have a monthly webinar, acepassive.com, if they want to join and learn about passive investing. And I have something for operators as well, aceoperators.com, if you want to ace your operation. So all kinds of ways to find me.
That's wonderful. So lots of knowledge sharing happening. So I'm glad to see it. This is one of the reasons that I love this industry. So experts like Sandhya and others are just so willing and so willing to share their knowledge with everybody. And so definitely go check out her website, her LinkedIn, and Ace Passive and Ace Operators.
That's it.
Right? Definitely go check those out and learn more. Again, thank you, Sandhya, so much for sharing your story, and looking forward to having you on another episode of Spur Your Wealth podcast.
Thank you, and congrats on your podcast.
Thank you. And for our listeners, thank you for tuning in to this episode of the Spur Your Wealth podcast. Again, we are Param Singh and Rav Singh from Spur Equity. Remember that your journey to financial freedom begins with both knowledge and action, where knowledge is power,
but action is superpower. So until next time, happy investing. Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at SpurEquity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@SpurEquity.com. Until next time, happy investing.